Okay, so once again, good evening. So as I mentioned, there is certain way for us to compute the return of investment. So again, as what our presenter earlier mentioned, a return of investment is a financial metric that is widely used to measure the probability of gaining a return from an investment. So it is a ratio that compares the gain or loss from the investment relative to its cost. It is useful in evaluating the potential return from a standalone investment as it is in comparing returns from several investments. So in business analysis, ROI and other cash flows measures such as internal rate of returns, yung IRR, and net present value or yung NPV are the key metrics that are used to evaluate and rank the attractiveness of a number of different investment alternatives. Although ROI is a ratio, it is typically expressed as a percentage rather than a ratio. Okay, so a while ago, our presenter gave us a basic or the simple formula in getting the ROI. So net return on investment over cost of investment multiplied by 100%. And she also gave us an example of a computations, a problem in a computations. Okay. So this time I'll just want first to hear a second presentations related to modeling of investment return before I will continue to give you some inputs related to ROI. Okay, go ahead.
Modeling of investment return. What is investment return? A mathematical formula that investors can use to evaluate their investments and judge how well a particular investment has performed compared to others. The formula: investment return equals return minus the investment divided by the investment. From this formula, the return is the profit on your investment, while investment is the cost or the amount that you spent. Now, let's make an example to understand more clearly. Case A. Mr. A invested 10,000 pesos. Then the investment gain a gross profit of 13,000 pesos. The net profit will of 3,000 pesos. To compute the return in investment or the ROI. ROI equals gross profit of 13,000 pesos minus investment cost of 10,000 pesos. You will get profit of 3,000 pesos. Then divided by the investment cost of 10,000 pesos. Your ROI will be 0.30 or 30%. Now, case B. Mr. B invested 150,000 pesos. Then the investment gain a gross profit of 187,500 pesos. The net profit will of 37,500 pesos. To compute the return in investment or the ROI. ROI equals gross profit of 187,500 pesos minus investment cost of 150,000 pesos. You will get profit of 37,500 pesos. Then divided by the investment cost of 150,000 pesos. Your ROI will be 0.25 or 25%. Now the question is, which investment is most profitable? Let's compare these two examples and analyze between case A or case B. Case A invested 10,000 pesos. Case B invested 150,000 pesos. Which case B invested more than the case A? Case A has a gross profit of 13,000 pesos. While case B has a gross profit of 187,500 pesos. Case A gain a profit of 3,000 pesos. While case B gain a profit of 37,500 pesos. Case A the ROI is 30%, while Case B the ROI is 25%. If you look at the amount of profit only, Case B is better than Case A. But we should also consider the ROI. ROI of Case A is higher than Case B. Then this could only mean that Case A is better than Case B. What does it mean if ROI is high? The ROI ratio is usually expressed as a ratio or percentage and is calculated by taking the net gains and net costs of an investment. A higher ROI percentage indicates that the investment gains of a project are favorable to their costs. That's why Case A is better than Case B.
Okay, so again, as to what our shared video presentation, no? Interpreting the return on investment, no? When interpreting ROI calculation, it's important to keep a few things in mind, no? First, ROI is typically expressed as percentage because it is intuitively easier to understand as opposed to when expressed as a ratio, no? Second, the ROI, no, calculations include the net return in the numerator because returns from an investment can be either positive or negative. So when ROI calculations yield a positive figure, it means that net returns are in the black, no, because total return exceeds the total cost. Alternatively, when ROI calculations yield a negative figure, it means that net returns are in the red because total cost exceed total returns. No? In other words, this investment produce a loss. Finally, to calculate ROI with the highest degree of accuracy, total returns and total cost should be considered. So for an apples to the apples comparison between competing investment, annualized ROI should be considered. No? So in computing the step-by-step analysis of the calculation, we need to calculate return, net returns, total returns, and total cost must be considered. Total return of a stock result from capital gains and dividends. So total cost would include the initial purchase price as well as any commission paid. Okay? And if you further descend the ROI into its component parts, it is revealed that there are certain percentage capital gains from the dividends. And this distinction is important because capital gains and dividends are taxed at different rates in most jurisdictions. So it depends upon to other countries. No? And ROI is equal to capital gains percent minus commission percent plus dividend yield. No? For us to get the capital gains, no, of course, we have also different computations for commissions, for dividend yields, and return on investment. No, so a positive ROI means that net returns are positive because total returns are greater than any associated costs. No? So a negative ROI indicates that net returns are negative, total costs are greater than returns. No, now. Actually, there are certain alternative return on investment calculations. So and we have also a computations of annual return on investment. The annualized ROI calculations provide a solutions for one of the key limitations of the basic ROI calculations. So the basic ROI calculation does not take into account the length of the time that an investment is held, also referred to as the holding period. Okay, so we have also another formula for annualized ROI. Okay. We have also comparing investment and annualized return on investment. No, annualized ROI is especially useful when comparing returns between various investment or evaluating different investment. So we could assume that there is certain computations of an annual ROI also. Okay, then. Combining leverage with return on investment. So leverage can magnify return on investment if the investment generate gains. However, by the same token, no, leverage can also amplify losses if the investment proves to be a losing investment. Okay? So we have also a unequal cash flow, no? The problem of unequal, no, or unequal, no, unequal cash flows. No, when evaluating a business proposal, it's possible that you will be contending with unequal cash flows. No, in this scenario, return on investment may fluctuate from one year to the next. No, so this type of ROI calculation is more complicated because it involves using the internal rate of return, no, function. Actually in Microsoft Excel or even in calculator. Okay, so of course the substantial difference in the IRR between those two scenarios. So despite the initial investment in total net cash flows being the same is both cases has to do with the timing and the cash flows. Now, in the first place, substantially larger cash inflows are received in the first 4 years because of the time value of money. These larger inflows in the earlier years have positive impact on IRR. Okay, I just want to share once again a video presentation using Microsoft Excel, no, in computing a return on investment, which is also an important that we have an idea on how we'll be able to utilize Microsoft Excel in computing return on investment and on how we'll be able to use Microsoft Excel to calculate the return on investment. Okay, so because actually this will be the simplest way or a very user-friendly software, no, such as a Microsoft Excel for us to compute the return on investment rather than calculator, no. Wait.
Return on investment. Now, hey, there's students. In today's video, we're going to be talking about how to calculate return on investment. Now, we're going to go through what is return on investment, like what does it really mean, talk about how to calculate it, and go through a big practice problem. Let's take a look. So, first off here, what is return on investment? Well, anytime you see the word return, anytime at all, and I'll make this big, this actually means net income. So what they're really asking here is how much income was earned from that particular investment that you made. So that investment can be a lot of things. Usually in accounting, you'll see stuff like they invested in a piece of equipment, a piece of machinery, or maybe a new building. And they can calculate how much money are we going to earn from that. Sometimes you invest in stock, trading securities, different things. So I'll just say investments can be a lot of things. Investments can be stocks, can be a machinery, equipment, maybe even a vehicle. Usually it's a fixed asset of sorts, a building.
Everyone loves spreadsheets. Actually, they don't. But check this out. Okay, Monday.com, get started.
Other types of securities as well, so other types of investments like that. So it's really about like how much am I making back from what I'm putting in. If I put in $1,000 in the stock market and I make back $3,000, that's pretty good. That's a good return on investment, right? I put in $1,000, I get $3,000 back. We all would do that, right? So that's really what return on investment is. The return means how much income I'm getting back from that investment. And give me one sec here. So we wrap that. Now, how do we calculate that? Well, it's fairly simple. Now, there's lots of formulas out there. We're going to go through the basic calculation here, really. It's just the amount of net income divided by the total asset that you invested in. So total asset. And again, that could be stocks. It could be machinery, equipment, vehicle, building, securities. There's so many things you can invest in, right? But it's really just the amount of net income you get back divided by the total assets. So net income over total assets. And that's basically it. Now, there are lots of other types of formulas you might see in your textbook or online, but this is the most basic one and the one that really spreads across multiple types of industries. So let's take a look at a problem. It'll really make a lot more sense here. Okay, so now a practice problem. So we're going to talk about how to calculate return on investment here, go through a big problem so you understand it. Now, Thunder Inc., they purchased a new piece of machinery for $185K at the beginning of 2019, so very beginning of the year. They're expected to receive a reported $305,400 in income, so they're getting money back after making that investment before taxes, though, for that whole fiscal year of 2019. This machinery will increase their production by 25%. The tax rate for Thunder is 35%. What is their return on investment for 2019? So just for 2019, let's focus on that here. Now, the first thing you have to do, so this is step one, is we have to go ahead and calculate net income. Now, why do I say that? Because it says they give you the income before taxes. And if you remember, the formula for return on investment is net income divided by total assets invested, right? So we have to get income after taxes. That's what net income means, after taxes. So to do that, there's actually two ways to do it. I'm going to show you both ways. First off, let's get the tax rate. The tax rate is 0.35. So I'll make that big here. Remember, tax rate for Thunder is 35%. Not 25%, 35%. And we also know the income before taxes is $305,400. So $305,400. So how do we get income after taxes, or net income? Let me show you. So one way to do it is you do a formula. You take your income before taxes and you multiply it times the tax rate. So $305,400 times 35%. And you get this number here. And I'll unbold this and make this a little bit more easy to understand. There we go. So it's $106,890. So what that is your income tax, the amount of tax on your income. And I'll format it to look like this here. So let me move this back over. That's just how much your income tax was. That's it. Now we need to get net income. To do that, we take our income before taxes and we subtract our income tax. That's it. So $305,400 here minus the $106,890. So let's do that. Equals $305,400 minus $106,890. That right there is our net income. Now, there's another way to do it. You can also find your net income by taking income before taxes, multiply times 1 minus the tax rate. So, what is that? Well, you take $305,400 times 1 minus 0.35, right? That's your tax rate, remember? 0.35 is your tax rate. And I'll write that next to it so you see it up here. And this was your income before taxes. So let's go ahead and multiply that out. $305,400 times 1 minus 0.35. Now you can probably just do that math in your head. We can even do it right here. 1 minus 0.35. I'll have to make this come out a little bit. There we go. 0.65. Then we just take $305,400, which is your income before taxes, times 0.65. There we go. $198,510. That is your net income. So you see there's two ways to get to it. You can multiply it times the tax rate, then subtract it from income before taxes. Or you can just say income before taxes times 1 minus the tax rate. Either way. So that was step one. Step two is you calculate return on investment. And again, that's going to be your net income divided by total assets. So we already got our net income. We'll just move it down. 198,510.
Magpresto ka na,
let's see here. I'm going to paste special this, make it values only. Well, never mind. I won't do that right now. I'll just do easy here. So we'll just write this in. 198. It's typing up there. 198,510 divided by total assets, which the machinery is your asset here. That's it. 198,510 divided by 185,000. And I'll do a formula. So 198,510 divided by 185,000. Make sure you get rid of the comma. There we are. And I'll move it over so you can see it. And I'll make it bold. That is your ROI, or return on investment. 1.07302, etc., etc. We can even shorten it down further and just call it 1.07. Now another way to write this is 107%. 107% as well. And so here's the key. This number is over 1, which is what we want. That means you're getting more back than you're putting in, right? 198,510 is larger than 185,000, right? So you made money on this, which is good. You want to make money on your investments. That's why they call it your return on investment. This is a positive return on investment, which is a great thing. So that is what you're looking for, over 1. Now, sometimes you can also have negative return on investment, and if that's the case, you lost money on that investment. Not that great. So 1.07 is your return on investment. So in this video, we talked about what is return on investment. We talked about how to calculate it, what's the formula, and went through a big practice problem here where I showed you first how to calculate net income and how to use that net income to actually, and I'll make this step 2, how to calculate the return on investment. So hopefully this video was helpful. If you did like it, please like and subscribe to this channel. It does help support me.
Okay, so again, it is important for us to understand that the biggest benefit of return of investment is that it is a relatively uncomplicated metric. No, it is easy to calculate and intuitively easy to understand. So ROI simplicity means that it is often used as a standard universal measure of profitability. So as a measurement, it is not likely to be misunderstood or misinterpreted because it has the same connotations in every context. No? There are certain cons actually of the ROI. No, the cons of ROI or return on investment. There are also some disadvantages. No, as I mentioned. First, it does not take into account the holding period of an investment, which can be an issue when comparing investment alternative. Let's say, for example, no, assuming investment by Juan no generates an ROI of 25%. While investment of Ana produces an ROI of 15%. So one cannot assume that Juan is the superior investment unless the time frame of each investment is also known. So it's impossible that 25% ROI from the investment of Juan was generated over the period of 5 years. But the 15% ROI from investment of Juana was generated is only 1 year. So calculating annualized ROI can overcome this hurdle when comparing investment choices. Second, ROI does not adjust for risk. No, it is common knowledge that investment returns have a direct correlations with risk. No, so the higher the potential returns, the greater the possible risk. No? And this can be observed firsthand in the investment world, where small cap stocks typically have higher returns than large cap stocks, no, but are accompanied by significantly greater risk. No? So an investor who is targeting a portfolio return of 12%, let's say for example, would have to assume substantially higher degree of risk than an investor whose goal is a return of only 4%. Of course, now if an investor owns only the ROI number without also evaluating the associated risk, the eventual outcome of the investment decision may be very different from the expected result. Thirdly, no, ROI figures can be exaggerated, no? If all the exaggerated costs are not included in the calculation. So this can be happen either deliberately or inadvertently. Let's say, for example, in evaluating the ROI on a piece of real estate, all associated expenses should be considered. And this include mortgage interest, property taxes, insurance, and all costs of maintenance. So the expenses can subtract a large amount from the expected ROI without including all of them in the calculations. A return on investment figure can be grossly overstated. So finally, like many profitability metrics, now return on investment only emphasize financial gains when considering the return on investment. It does not consider ancillary benefits such as social or environmental goods. A relatively new ROI metric known as social return on investment helps to quantify some of these benefits for investor. So I just want to play a video again. It's just only enough.
Return on investment is a calculation that shows how an investment or asset class has performed over a certain period of time expressed in percentage terms. The formula for calculating return on investment is very simple. It's simply the last value minus the beginning value divided by the beginning value. So let's test this out. In our table, we can see that the last price for 2018 was 115 and our beginning price was 100. And therefore, the return on investment is 15%, and this carries throughout the table. Following financial modeling best practices, we do want to break out each different year as its own line item to get a sense of where the return on investment was up and subsequently down. One advantage of return on investment is that it's so simple and comparable. We can say, hey, this asset in the year 2020 returned us negative 18%, but hypothetically, some other asset returned us a positive return. Now, the big problem with this is that it doesn't consider the time value of money. It is preferable to link the returns year over year, which is effectively an annual rate of return or a compounded rate, whereas this just takes each year in static and assumes that this is an arbitrary endpoint in our calculation. But this video shows you the basics of how to calculate it, and it's quite simple to do.
Okay, so as what our the bottom line here is return on investment is a simple and intuitive metric of the profitability of an investment. There are some limitations to this metric, including that it does not consider the holding period of an investment and is not adjusted for risk. However, despite these limitations, a return on investment is still a key metric used by business analysts to evaluate and rank investment alternative. Okay, so whatever your learning style, understanding corporate finance and accounting is easy when you can choose, of course, different applications with applying the return of investment computations. Okay, so again, ROI must of course, or return on investment is an appropriate measure of an investment profitability. ROI has a wide range of application. It can be used to measure the profitability of a stock investment when deciding whether or not to invest in the purchase of a business or evaluate the result of a real estate transaction. ROI is calculated by subtracting the initial value of the investment from the final value of the investment, which is equal to the net return, then dividing this new number, the net return, by the cost of the investment, and finally multiplying it by 100. So ROI is relatively easy to calculate and understand, and its simplicity means that it is a standardized, universal measure of profitability. One disadvantage of ROI is that it doesn't account for how long an investment is held. So a profitability measure that incorporates the holding period may be more useful of the investor than wants to compare potential investment. Okay, so I think that's it for this topic.